Welcome to Ben's Market Insights, episode 15. I want to talk a little bit about the US consumer today, still very strong. What the ghost of Epstein potentially has over the US economy. And I also want to have a discussion around what potentially the Japanese bond yields tell us about global liquidity. And then when we think about the micro picture, I kind of want to address the issue around the AI bubble that people are talking about and the potential impact of that on markets. So let's start with a big picture. It's very clear from the latest information we've had from MasterCard that the consumer over the Black Friday period has actually been very strong. In fact, online sales are up some 9% year on year. So the resilience of that US consumer, which is key to the US economy's growth into next year, is certainly it remains in place. So the ghost of Epstein and the US economy, what am I talking about? Well, it's very clear to me that what we're seeing at the moment is with the release of and the voting by Congress to release the Epstein papers and President Trump's if you like, sort of vacillations about whether he should do that or not, and in fact ended up having to do that, has cast a shadow over the Republican Party come the midterms in November next year, as well as his role as an active president. So was the Epstein case the precursor to effectively creating a lame duck president ahead even of the midterms, which is normally the time when we start to see that in place? And if that were to be the case, do we start to see a slowdown in the deregulation of the economy, of the, if you like, laissez-faire animal spirits that the market is expecting from the current administration? That could well be the case. And that could be a scenario where slowdown, or certainly an economy that is not accelerating at the sort of pace that the investors had hoped for over the next 2 to 3 years. It's something to keep in mind for sure. When it comes to global liquidity, one of the key factors I think that's worth keeping in mind is that the 20-year bond yields in Japan, something that one of our callers and one of our listeners has highlighted, and very grateful for that, is that we're now punching through 1.75%, or rather 2.75%. This is an important juncture because after costs, it implies that a Japanese investor is better off investing in their own domestic treasury market than going out to seek yield elsewhere. Given that Japanese investors, both institutional and private, have tended to really buttress the US Treasury bill market, the implication here is that there is going to be a withdrawal of Japanese capital from the US Treasury market back into the domestic market. And I think that that is very significant because some estimates put this at upwards of $500 billion or more. So does this mean that if the Fed begins or continues rather down the road of easing with further interest rate cuts, is that easing on capital eroded by the withdrawal of capital by Japanese investors? It could be marginal, it could be significant. Nonetheless, I think certainly something to keep an eye on in terms of the liquidity as we go forward into next year. Certainly markets have been fretting about a Fed rate cut, and I suspect that we still might see that in December. And if we're not going to see it in December, we're certainly going to see that in the first quarter, so that we would continue to see something in the region of 100 basis points of cut into next year. Let's move to the issue around the AI bubble and what I'm talking. There's two specific factors I want to cover. In the first instance, we want to talk about depreciation. So what's happening here is that in many cases, the lifetime usefulness of a GPU is looking like it's around 2 years. But at the same time, the depreciation, if you look at some of the key companies that are dealing in this area, is running at around 6 years. In other words, if the useful life is only 2 years, but you're able to depreciate the value and therefore take on a cost at a much more passive pace of 6 years, it means that you're overstating your earnings. And I think that that is something that certainly has been going on. And it's certainly something that we need to keep a very close eye on, because from my perspective, when we look at something like a CoreWeave, which effectively rents out data center GPUs to other data center providers, they are depreciating over a 6 year period. And certainly that is a significantly aggressive form of depreciation versus what I think most people would suggest would be the useful life of a chip. The main issue, as far as I'm concerned, is not so much these marginal businesses like a CoreWeave, but the fact that the large tech companies are not really heeding this issue. Certainly when it comes to Meta, they recently increased their depreciation period on their server life by up to 5.5 years. And so certainly going the wrong way, if you like, and that is overstating their earnings to some extent. The good news is companies such as Amazon have actually recently reduced their treatment, or reduced their depreciation period for their data centers from 6 to 5 years. So there's certainly some kind of understanding that the useful life of a chip is shortening as innovation is increasing at pace. Microsoft, in their recent filings, have suggested that server usefulness is around 2 to 6 years. So again, realizing at the bottom end of that there is an issue. And even private credit funds have been taking GPU as collateral for loans. And if the value, of course, of those GPUs start to fall, then we're in trouble in terms of the collateral that these private equity firms are holding. The other key issue is overcapacity. OpenAI have effectively signed a $300 billion data center deal with Oracle. Oracle did incredibly well for a while. And then as investors realized that this is, if you like, capacity that needs to be filled over the next few years by OpenAI, and there is no guarantee of that, the Oracle share price started to fall in quite aggressively. Now, what's interesting here is that OpenAI has also got a $250 billion capacity deal with Microsoft in its Azure Center for GPUs, which, if you think about it, for a company like OpenAI, and we have very little information about it given that it's private, has a revenue of some $12 billion and a valuation of about $100 billion. Where are they going to get some $550 billion worth of demand in order to supply that level of capacity into those data centers that no doubt Oracle and Microsoft and others are going to start investing into and are doing so? So it feels to me a little bit like, if I take the analogy of WeWork, when that kind of started to crumble, what WeWork was essentially doing was going to landlords and saying, look, I can take the vast majority of your office space for very high levels of rent, but I need you to give me 5 years worth of grace period on my rent as I fill up the building, and then you can start charging me. Of course, they signed multiple agreements and contracts like that and couldn't deliver in terms of the capacity of rentees or sublessees, which led eventually to WeWork's demise. And I'm concerned that we're getting into that world today as far as AI and the bubble is concerned. So I think in summary here, the earnings, I think, are overstated in the AI space, which we need to be very conscious of. I think there is certainly overcapacity issues, and that's nothing new in the semiconductor sector. Trump has actually in the past acted or has talked about being a backstop for AI investments in the US, but then started to walk that back. And NVIDIA, which has consistently said that it is able to fill its capacity, when it reported most recently, didn't stray from that. So it's continuing to push the idea that demand in the AI space is very early stage. It could well be the case, and it could well be the case that that capacity gets filled very quickly. Nonetheless, it's certainly something to keep in mind, and at valuations that we're seeing today in this space, certainly a concerning element. Anyway, I'll leave it there, and we'll speak next week.